Just give me a thumbs up whenever the screen is. Okay, thank you so much. Okay, good evening again, everyone. So, like I mentioned earlier, today we just saw the PYQ. Unfortunately, there are only two PYQs in this course, so let's take them one by one. And in case you have got any other question from the GS or the PS or any concept which has been dropping you can raise it here and then we'll solve it. Okay, with that, let's come to the PYQ. Okay, so this is the first one, PYQ. The first question is the put call parity result for a non-dividend paying stock. It states that the European put price plus the present value of the strike price must equal the European call price plus the stock price. So what it is saying? It is saying put price P0 plus the present value of the strike price. Present value of the strike price is X plus 1 plus RF over P is equal to the call price C0 plus stock price. But we know that this is wrong. The put call parity result is opposite. This is incorrect. Correct. It's C0 plus X 1 plus RF over P is equal to P0 plus S0. This is the correct. If it is false. Is this okay with everyone?
Yes, sir.
Okay, and I will cover it here only. That if your this rate which is there, rate of interest, if it is continuously compounded, then this formula becomes C0 plus X e to power minus RT. This is what P0 plus S. So we have seen two formulas in this question. Now let's go to the next question. The delta of an option is the ratio of change in the option price to the corresponding change in the stock price. So this delta concept has not been covered in any of the lecture of corporate finance till now. So it's an unexpected question. However, the delta, remember, is equal to delta of C over delta of S or delta of P over delta of S. And if you remember, the formula for hedge ratio was also delta was something similar to this. So this delta is very, very similar to the hedge ratio.
Hedge ratios delta the call profit upon the
CU
change in
minus,
stock.
yes, CU minus CD over ST minus SU minus ST. So I've just given you this again so that you can remember if you forget what is delta. So you remember here from here and just replace these values C0 CD with your change in option price. Is that okay? So this is that. Both formulas. One is for delta and one is for hedge ratio. Is that okay? Suraj?
Sir, what is U and D here?
U is the when the stock price, for example, was at 100 rupees, which is S0, you purchased one call option for rupees 5 or for rupees C0, which you calculate. And then we say the strike price is 110, for example, this is X. So we say that there are two scenarios only. Either this share can increase to rupees 120 or this share can decrease to rupees 90. Okay, so this CU is your profit, this is U and this is D, down.
So it is up and down. So if the profit, if we are in profit, so it's up, and if you are in loss, and it's a downfall.
Yes. So here C will become 10 rupees. You get 10 rupees only, and CD is 40. Okay.
Got it, sir.
And if you are asked and given this scenario and asked to calculate U and D, so U and D, U is 120 by 100 and D is 95. So either it increases by 1.2 times or it becomes 0.9. Okay.
Yes, sir.
Okay, that makes sense. Okay. In the Black-Scholes formula, pricing formula, the stock prices are considered to be log normally distributed. So, can somebody help me with this? So, the price, stock price as per the Black-Scholes formula is something like ND1 minus ND. This is S0. This is S to the power of D. And how to calculate D1 and D2? D2 minus 2. And when you calculate this for D1, so this becomes ln of S if by S minus RF plus this by D divided by so when you see this formula, there is a logarithmic of S0 and S. So yes, again, it is considered as the log logarithm distribution. This okay? This are the two formulas. Yes, six. Suraj, if you can refer your notes and if you can keep on correcting me, sir, I might make mistakes.
Sir, I have one question in put call parity.
Yeah.
Suppose it is continuously compounded.
Yeah.
So what is X in the equation?
X is your strike price. This is your strike price.
Okay, sir. Okay.
And this is your present stock price. Okay. It is available here also. Okay, let's go ahead with the next question. A call option is in the money when the stock price is higher than the strike price. So this is true. I have purchased stock price was 100 as 0. I purchased for 5 rupees. Strike price is 110. So when the strike price will be greater than 110, then it will be in the money. If it is equal to 110, it is called at the money. If it is less than 110, it's known as out of the money. In the money means profit, at the money means profit loss, out of the money means equal at less than equal or having loss. Is that okay?
Sir, what about put option?
Put option will become opposite.
So 90 will be in the money and 120 will be out of the money.
Yes. Yes.
Okay.
Okay. Then the question liabilities of a commercial bank.
So, sir, one more
Yeah.
question follow
Yes.
up. Suppose they say for selling a call option,
Okay.
then would in the money out of the money apply?
Oh, yes, again, it will again apply. So you have to just see in that scenario, in this scenario, you are making money. This will be,
In case of selling a call option, I'm primarily making money with the premium, right?
yes, see what is happening when you sell the option. You are selling option. So somebody has purchased one option and his money has come to you.
Yes.
Now strike price is for example 110. If it increases to 120, you have to pay 10 rupees. So you are in loss.
Correct.
So this is out of. If it is only less than 110, then only you will be in the.
Sir, I have a question. So, we were told that in option we can maximum bear the loss of the premium. But if we are selling the option, so the cost would be infinite.
Unlimited. Yes.
Got it.
Okay.
Sir, what if the price went to 115?
115, then
Yeah,
you are at the
will be at the money, right?
at the okay. So there can be only three scenarios: out of the money, at the money, in the money. Is that okay?
Okay, sir.
Let's go to the next question. Liabilities of a commercial bank include loans, deposits with other banks, and the central bank, and various securities that apply. So these are not the liability; these are the assets. Liabilities will be the money which banks owe to customers. For example, customers they have deposited their money, go to central bank, owe money to lenders. So those are the liabilities. These are nothing but the assets. So this is statement is false. And next question, the part of the minimum variance frontier that lives above the global minimum variance portfolio is called the efficient frontier. This statement is true. And just you have to remember this graph. The minimum variance frontier is something like this. This is the place where the minimum variance. And your minimum variance frontier, which is at the efficient frontier, it is always above this. So this is the place where it is efficient. It will never be below this. That's why this statement is. Now we come to, according to CAPM, projects with higher beta require a lower expected rate of return. So we covered the formula here. So as per CAPM, your expected return of any asset I is equal to RF plus beta into expected rate of the market minus RF. This term is also known as premium. So as beta increases, your ERI increases. So ERI is directly proportional to beta. Is that okay?
Yes, sir.
And from here only you can calculate the formula for beta also. Beta will be ERI minus RF divided by ERF minus RF. Let's proceed next. When assets have a perfect positive correlation, there are no benefits from diversification. So this is true. Why this is true? Because why would you diversify? Like I have got two assets A and B. Diversification. So I diversify so that if my A is going in loss, my B should be going in profit so that I become risk free. I reduce the risk so that my risk reduces. If A and B move in the same direction, then when A goes down, B also goes down. So my risk is increasing. So in diversification, the correlation coefficient which is there, this should not be equal to perfect 1. And in the perfect scenario, this should be equal to -1. Is that clear? This concept, diversification. Okay. Am I audible? Can somebody?
Yes, sir.
Yes, sir. Yes, sir.
Okay. Okay. The yield curve shows the relation between interest rates and maturity. This is true. So the yield curve formula is on the horizontal axis is the interest rate, and on the y-axis is the maturity. You can remember this. So this would be as the interest rate increases, the maturity amount increases, and here is the interest rate is C. This is true. Okay, the next question will come. An investor can diversify the systematic risk. So this we know the systematic risk cannot be diversified. Systematic risk cannot be Diversification. Next question.
Sir, what are examples of systematic risk?
Systematic risk are, for example, Corona came. Now, for the Corona kind of crisis, could you diversify your assets? All the assets that you know.
No.
So these are some certain examples. Now suddenly war breaks out. So that is a systematic risk. Next question. You found an ancient painting in your home that was purchased by your father 20 years ago for ₹1,000. You auction it and sell it for ₹30,000. What is the annualized rate of return that is earned on this painting? So here the formula is that your final amount is equal to 1 plus RF into P into X0, and this is your X final. When you put 30,000 is equal to 1,000, 1 plus RF, the P has been given to you, 20, and then you can calculate 1 plus 20 into 1 plus RF is equal to, this will become 3,000. Therefore, 1 plus RF is equal to 30,000, 3,000 over 1 by 20, use the calculator, and then divide RF. Only in this catch is this is one formula. If they tell you that rate is continuously compounded, then this formula, what it will become? This will become X is equal to X0 into 1 into power minus 30. So not minus 30 into power 30. It's okay. Any question on this question?
No, sir, got it.
Okay. Tata Steel stock is trading as ₹300 today. Tata Steel is expected to pay a dividend of ₹20 per share next year. If the growth rate of Tata Steel dividend is 2% every year, and the absolute rate of return is 7% per year, then according to the Gordon growth model, what is whether Tata thinks this stock is underpriced or overpriced? Okay, so what is the formula for Gordon growth model? Gordon growth model says that your price is equal to dividend divided by R minus G minus R. G minus R, where is the P is the price, D is the dividend, G is the growth, and R is the rate. So see, if we put everything here, so P is equal to D is 20. G is appropriate rate of return is 7%. Sorry, this is R minus G. This is R minus G. R is 7%, so this becomes 0.07. This becomes minus 0.02. So this will become 20.0705. Remove this, so this becomes 500. So your stock price as per the Gordon growth model should be 400. However, it is 300. So in this case, what it is inferring that the stock price is underpriced, and the investors, they should buy the Tata Steel shares. Is this okay? This formula?
Yes, sir.
Now, next question. There are two assets: a risk-free asset that offers a 6% rate of return, and a risky asset that has an expected rate of return of 15%. The standard deviation of 10%. What is the slope of the capital allocation consisting of these two assets? So, how do we solve this question? Can somebody tell me?
RM minus RF divided by standard deviation.
R by RM minus RF by standard deviation. Slope of Cal. And Cal का meaning क्या होता है? That RM is equal to RF plus S of L sigma standard deviation. Put it here in this formula and get the answer. Okay, next we come to, there are two risky assets that are negatively correlated with P is equal to minus 0.5. Asset 1 has an expected return of 15%, standard deviation 10%. 2 has expected return 20%, standard deviation 12%. What are the weights of the assets in the minimum variance portfolio? So for this formula is W1 is equal to sigma 2 square minus variance of A and B divided by sigma 1 square plus sigma 2 square minus 2 into variance of AB. And variance of AB is nothing but equal to correlation coefficient and sigma 1 sigma 2. So put all these values here, so you will get W1 is equal to sigma 2 square, sigma 2 is 12%. So this will sigma 2 square becomes 0.0144 12 square minus covariance is minus into minus 0.5 and to sigma 1 is 0.1. This is 0.2 and the denominator becomes 0.0144 plus sigma 1 square becomes 0.01 minus 2 minus 0.5 into 0.1. And solving this, we can get W1 and W2 will be nothing but 1 minus W1. Is this okay?
Yes, sir.
Okay. And in my last session, I had explained that if you forget this formula, still by using the variance formula, you can still find the answer. Okay. Now we come to the next question. Sahitya income is considering two different projects, A and B, for investment and can choose at least one project to invest in. Project A cost is 12,000 and is expected to generate 5,000 in 1 year, 10,000 in 2 years, second year. Project B costs 10,000 and is expected to generate 5,000 1 year, 4,000 in year 2, and 3,000 in year 3, and 2,000 in year 4. So Sahitya's income required rate of return for these projects is 5%. Which of the following is true? What should they prefer? Project B, project A, what they should prefer? So this is nothing but this is an NPV question. So we calculate NPV A. NPV A equal to investment is 12,000, so this becomes minus 12,000 plus 5,000 1 year. Rate of return is 5%, so it becomes 1.05 plus second year 10,000 divided by 1.05 square, and NPV E will be equal to minus 10,000 plus 5,000 1.05 plus 4,000 1.05 square plus 3,000 so 1.053 and 1,000 and now what you can do, you can just straight away do NPV A minus NPV B. So this term will cancel out, minus 12,000 plus 10,000 minus 2,000 and 10,000 this will come 10,000 minus 4,000 6,000 divided by 1.05 square minus 3,000 over 1.05 minus 1,000 over 1.05. So find this value. If this is positive, then you go for A. If it is negative, then you go for B. It's okay. And if you solve it, it will come negative. Any question on this by anybody?
Got it. So this approach is like really good. Subtracting.
Yes,
I
yes.
was manually solving earlier.
Yeah. So some of the terms they cancel out.
Yeah,
Sir, can you
it's a good.
explain that positive negative part again?
So if your NPVA minus NPV is positive, it means your NPVA is greater than NPV. So you go for A. And if it is negative, then your NPV is greater than NPVA. Then you go for B. And if it is 0, then you are indifferent. You can go for anything. Is this okay?
Yes, sir.
Okay. Okay. Next we go British pound buys 100 Russian rubles. The GDP deflator is Russia in Russia is 110. GDP deflator in UK is 105. What is the real GBP to people exchange rate? Note exchange rate is defined with the UK as the home country and Russia as a foreign country. Okay. So we can do in two ways. I will just give you example. For example, when we consider India to USA and we say $1 is equal to 80 rupees, so then we take exchange rate is equal to 1 by 80. And the real exchange rate, if I call RE, is equal to E into GDP deflator India over GDP deflator USA. Now, with the same concept, use this, RE will come, E will become 1 by 100. Deflator becomes GDP deflator in Russia is 110. But they have given that your home country is UK. UK is your home country, Russia is a foreign country. So this becomes 110. So if you solve this and you get the answer. Is this okay? Shall we solve it? This is correct. This one is 0.9545. Is this okay?
Yes, sir.
Next question. The prevailing interest rate in India is 9%. Prevailing interest rate in UK is 5%. What is the expected rate of appreciation of INR to GBP exchange rate? So for this, the formula is 1 plus I is equal to 1 plus I star divided by 1 plus delta B. Here I is your interest rate, domestic. I star is foreign interest rate, and delta E is the rate of appreciation. Here asking. So this will become 1 plus 0.09, 1 plus 0.05, 1 plus delta E. So open this and you get 1.09 plus 1.09 delta E equal to 1.05. Therefore, delta E become 1.35 minus 1.09 divided by 1.09. So you can see from the numerator that it is a negative. And this will come as a minus 0.036. It is okay. So remember this formula. I think this is from the 11 of you. Okay. Now we come to our favorite call option. The share price of Infosys is 500 today. A trader invests in Infosys by buying 100 European call options on Infosys for ₹10, each with a strike price of ₹490 and maturity of 3 months. What is the gain or loss? The share price of the maturity date is rupees 495. So what has happened? The price was 500 as zero. He has purchased 100 European calls for rupees 10 each. It means he has paid how much? He has paid 1,000 rupees. Okay. He has paid 1,000. Now the strike price is 490 and the rate has to be 495. So how much profit he will get for each share? He has got 100. So profit will become 100 into 5 rupees. 495 minus 490 is 500. So your net is how much? Net will be 500 minus 1000 is equal to minus 500 is 500 loss. Is this okay? Is that the one?
Yes, sir.
Now we come, which of the following describes a short position? So short position, always remember, it means shorting. Shorting means that you are selling. Always mean short means you are selling. So take this a position in an option lasting than 1 month, incorrect. Position in an option lasting less than 1 year, incorrect. Position where an option has been sold, that is the shorting. The position where an option has been purchased, this is not shorting. Shorting means always, short means selling. Now consider.
And similarly, if the question comes about the long position, then we will kept it for the buying, right?
Yes, long means when you are purchased.
Right.
Long means, long position means purchase. Now we come to next. Consider a put option and a call option with the same strike price and the time of maturity. Which of the following is true? So it says the put option, call option, same strike price, same time of maturity. Then your call put parity, it comes into play, which says C0 plus X upon 1 plus RF into P is equal to P0 plus S0. And this is nothing. If you correlate, it means that if your call is going in loss, then your put will go in profit. If your call is going in profit, your put will go in loss. So either one of them must be either in the money or at the money. If both cannot be at the money and both cannot be out of the money at the same time.
So both can be at the money, like if both are like it's on a strike price. If you take position at the same strike price, put and call.
Same strike price, but what happens in that you are not considering the amount which you are paying. You have to pay the amount also something.
Yes, premium.
Yeah, so there will be a premium also.
Got it.
So this question shall we confirm if you this is not clear, this is not clear. Question is this. If this is the person which has got the correct answer in the answer. The question is the price of the stock is rupees 84, but trader buys a put option. So he is buying a put option with a strike price of rupees 80, with an option price of 10 rupees. So he has paid 10 rupees. The strike price is 80. Now, what are the scenarios when he will make profit? So see, he has already paid 10 rupees. So his profit which is there, so it has to be at least less than 70, then only he will make profit. Here in all the scenarios, above 80 is loss. And Only if it goes less than 70, then only he will get more than 10 rupees. So the price has to go less than 70. Is this okay with everyone? Any doubt or any question on this? Am I audible?
Yes, sir. Yes. In buying a put option, you only make money if it goes down, right?
Yes, yes.
So maximum amount of profit I can make is strike price.
Maximum profit can be only strike price.
Okay.
Sir, and if the question comes with that call condition, then how we'll approach it?
Okay, so if you have got a call, for example, 80 rupees is there, you have paid 10 rupees, the strike price is 80 rupees, then it will make profit only when it goes above 80. Is that okay?
Yes, sir.
Okay, and here in total this is next question, when volatility increases with all remaining the same, which are the following is true. So both call and puts increase in the value. So I will cover for both call and put the relations. So this is call, this is put. So there are 5 factors. One is the stock price. Second is excess price. S, X. That is volatility. That called V. Then rate of interest. And then time. So call, when S0 increases, your call increases, whereas put decreases. When excess rate increase, your call rate decreases, your put rate increases. Volatility both increases, C0 also increases, P0 also increases. With rate of interest, both C0 and P0 increase. With the time interval, C0 increases, but P0 there is no relation. So these are the relations of call and put price. All this.
So for rate of interest?
The rate of interest both increases. Both will
Okay.
increase.
Sir, could you please go back to like a short question?
Yeah.
Where the answer is like 74.
Yes.
So it is saying like if the price is below 70. So let's say if the price is 73. So in that case,
Again, it's
the
a
trader will make loss.
Yes, so that's why I said the concept is incorrect.
Okay, the options are okay. Okay, got it. When the strike price increases with all remaining the same, so what we have seen, if the X increases, your C0 decreases and P0 increases. So call put will increase, but call will decrease. Is that okay?
Yes, sir.
Now, which of the following describes a protective put? So protective put is nothing that I have got a share, for example, of Reliance. So I have got one share of Reliance. And its present value is 500. So I don't know whether it will increase or decrease, but I want to reduce my risk that if it decreases below this, I should not suffer any loss. So what I will do, I will purchase one put of this share. So if it goes down below some price, I will earn profit from here. So if I'm incurring loss here, I will take profit here. So by purchasing this one put, I'm protecting my portfolio. That's why it is known as protective put. Is this okay? Is concept understood by everyone?
Yes, sir.
So what I'm doing, I'm buying a put option on a stock plus a long position in the stock. This is my long position, and this is my put option. Okay, and opposite of this is, if I am not wrong,
Covered call.
covered call. So in the covered call, what do? We have got a share, and I sell the call option. So the effect remains the same. That if this stock goes down, then I don't have to pay anything because I'm selling a call option. Okay, next one is you purchased two 1-year call options with a strike price of ₹80 and a 1-year put option with a strike price of ₹80. The call premium is ₹4, the put premium is ₹3. The current share price is ₹78. If 1 year later the share price increases to ₹87, so what is profit or loss? So what has happened? You have purchased two call prices and one put for call price is ₹4, so ₹8 in here, and premium price is ₹3, so you have invested ₹11. Okay, and the strike price is 80. Now this reaches 87. What will happen? For two call prices, you will get a profit of 2 into 7 is equal to 40. And for put, you will get nothing. From put, 0. So your net is equal to 14 minus 11 is equal to 3. And it is positive, therefore, profit of ₹3. It is okay.
Yes, sir.
Now we come to the price of a 3-month European put option on a non-dividend dividend paying stock with a strike price of ₹16, ₹6. The stock price is 58. The annual risk-free rate is 8% and continuously compounded. What is the price of 3-month European call option? So this is called put parity ratio. C0 plus x to power e minus RT, because continuously compounded, is equal to P0 plus S0. So we have to calculate C0. C0 will become P0, which is 6, plus S0 is 58, minus strike price is 60, and to e to power minus rate of interest is
8.
8%, which is annual. So this is 0.08, and it is a 3-month European put. So your T will become 1/4. So you calculate and you get the answer. It's okay.
Okay, sir.
Okay, now next question. A stock is trading at ₹100 today. In 3 months, the stock price can either increase to 120 or decrease to ₹90. The 3-month risk-free rate is 5%. A 3-month call option has an exercise price of ₹105. What is the risk neutral probability that stock price increases? So yesterday we had covered this formula. P is equal to X over 1 plus RF minus something was there. Somebody remember this formula?
Sir, 1 plus RF minus D upon R minus
Okay. So
U
here,
minus D.
yeah. So this is, if I'm not wrong, this was H to power X into power R minus 3 over U minus D.
U minus D, yes.
Okay. And U will become 120/100, which is 1.2. D is 0.9. Strike price of P will become, strike price is how much? 105. Into P to power R. R is 5%, so this is 0.05. It is a 3 months, so this will become by 4 minus 0.9 divided by 1.
Sir, what about 1 plus RF minus D upon U minus D? Because continuously compounded, it's not written, right?
Okay, so this will become What will be the formula? X divided by 1 plus RFD.
No, no, no. It will be 1 plus P equal to 1 plus RF minus D upon U minus D.
Just open something. So this is from which sheet?
I don't remember actually.
Okay.
I watched your only
Yeah.
revision session 2 days back.
Session. Is that this? This is the equation. By photo. This was from week 11. Week 11 covers that. Is
This
the
one. Yeah, yeah.
Let's go with this. And we'll copy this also. Okay, so this is one formula when it is not continuously compounded. This will be the formula. The second is continuously compounded. This formula. This is for continuously compounded, and this is for not continuously compounded. So if you put this will become 1 plus RF 0.05 minus 6.9 divided by 1 minus 6. So this is okay.
Yes, sir.
So we have to remember these two formulas. 2 power R T minus T minus T. Or if it is not 2 minus RT, then it becomes 1 plus RF minus T. Very good. Okay, next. Okay, so this question is about, this is incomplete, so let's see this question. This is so this is the question. That is the Black-Scholes for pricing formula for a call option. ND1 is this and ND2 is this. If the stock price increases by ₹1, what will be the change in the price of the option? So here, what will be the change in the price of the option? And it is a call option. So just remember that for call option, the hedge ratio is equal to ND1. It means the delta C over delta S is equal to hedge ratio, which is ND1, which is 0.6. Okay. So it means if your delta S is increasing by ₹1, if it is increases by 1, your delta C will increase by how much? 0.6. Okay. And if the same question comes for put, then for put, hedge ratio is equal to ND1 minus 1. Is okay with everyone?
Okay, sir.
You invest 60% of your money in a security with a beta of 1.35. The rest of your money in a risk-free security. Then what is the beta of your portfolio? So formula for this is beta is equal to summation of beta I into weightage of I. So there can be many assets. In this, they have given only two assets. So in this, it will become the beta portfolio. Beta I is 1.35 and to 0.6 and 0.4. It is a risk-free security. So beta is 0. So answer will become this. So 0.0. So in this question, hello.
Sir, can we use CAPM formula here in this question
But
and
this-
put?
but they're asking the beta of the portfolio. No? The portfolio is
Okay. Got it.
and now this question can also be asked again in these ways that you have got a investment base and your weightage is 0.6, beta is 1. B is you will invest 0.2, beta is 0.5. It is C asset you invest 0.1 and it is 2. And the D asset is risk free and you invest 0.1. So this is your weightage, this is your beta. So here beta will become 0. So your entire beta portfolio will become 0.6 into 1, 0.6, 0.2 into 0.5, 0.01, plus 0.1 into 0.2 is 0. And so this your entire will become 8. So if the question comes like this also, remember the formula. Beta portfolio is equal to summation of beta I weightage. Okay.
Got it, sir.
Then the next question. Your opinion. So there, this is an opinion which is there is about alpha. Your opinion is that Cipla stock has an expected rate of return is 15%. Cipla has a beta of 1.5. The risk-free rate of return is 5%, and the expected market rate of return is 12%. According to the capital asset pricing model (CAPM), Cipla is underpriced, overpriced, fairly priced, or insufficient information. So, how do we approach this question? We calculate expected rate of return, which is given by the formula ERI is equal to RF plus beta into expected market rate minus RF. So this will become what is RF? RF is 5%, beta is 1.5, market is 12 minus 5. So this becomes 5 plus 1.5 into 7. That's 5 plus 10.5 is 15.5. And now this is your expected rate, and your opinion rate is 15%. So it means now you calculate alpha. So alpha is equal to opinion rate minus ERI. So this will become 15 minus 15.5 is equal to minus 0.5. So if alpha is minus 0.5, if it is negative, then it is overpriced. Okay. And this question can also be asked in a form that these things are given. Should you invest in this investment or not? So in case this is negative, you should not invest in this stock. Is this okay?
Yes, sir.
Next question will come. The current price of a non-dividend paying stock is 50. Over the next 6 months, it is expected to rise to rupees 70 or fall to rupees 40. Assume the risk-free rate is 0. A 6-month call option with a strike price of rupees 55 is trading at 5. how many options are required to hedge the purchase of 2 shares of a stock? So here we have to find this hedge here. So we have to calculate the hedge ratio. Hedge ratio. So how do we go about it? The current price is 15, expected to fall to 70 or 40. This rate is 0, 16 strike price is 55, and your C is also there at 5. Current price is 50. How many options are required to hedge the purchase of 2 shares? So hedge ratio is equal to CU minus CD, which is 0, in case of call, divided by SU minus ST. So see here, if it is in profit, it will make a profit of how much? 15. CU is 15. It is okay. Will everyone? So your
Yes,
hedge
sir.
ratio becomes 15 minus 0 divided by 70 minus 40. This becomes 1 by 2. So for one call option, you will treat 1 by 2 shares. So for four shares, how much will keep there? Oh, sorry, for 2 shares. For 2 shares, how many call options will be there?
4.
Or
Yeah. So you will add plus call options. Now we come to the next. A risky asset has a 10% expected rate of return and a 20% standard deviation of the rate of return. If the Sharpe ratio of the risky asset is 0.8, then what is the prevailing risk-free rate of return? So what was the formula for Sharpe ratio? If anybody remembers? Sharpe ratio was something RM minus RF.
is it equal to slope of line?
Yes, slope of line, same thing. RM minus RF by sigma.
Standard deviation. Yep.
Yeah, so this they have given 0.8 and what the prevailing risk-free rate of return? Risk-free asset was 10%. Risk-free rate of return.
It should be 10 minus 0.1 into RF minus RF.
But this is the RF.
We have to find RF basically.
Yeah, RF remain like a variable only.
And sigma is how much? Sigma. Your RF is sigma minus 6%. Six. This is correct again? Check the answer. There is something wrong. Vivek, can you help me with this? We have making some mistake here.
So you
Sharp ratio.
0.2. Let me just calculate
This is
0.2.
0.2. So this will become 0.16. And this is on top. Again, we used to keep like something like RF. And what the prevailing risky rate, risky asset essentially from 10 is corrected.
You should
Minus-
take values like
minus
directly
0.1
10.
होगा.
So
minus 0.1 होगा, so it will be 0.06 ही आएगा. 0.16 minus 0.1 हो.
Is this formula correct? This one.
Yeah, everything is
This,
correct.
this
Answer would be
formula is
0.06.
correct, but the what your risk-free rate is actually a negative figure. It's going to be minus 6%.
Why they are doing this 6%?
I think this is a mistake because they have put enter single integer, so it should be actually minus 6.
So this is RM. RM is given 0.1 minus RF divided by 0.2. This is correct again?
Yes. So if you do it the other way also, the boss, if you do 0.1 minus 0.6 divided by 0.2, you'll get 0.8.
Yeah. So this is like minus 0.06.
Right. Absolutely.
So that's why this is minus 6%.
Yeah.
Thank you. Okay, next question. Do you purchase a 1 year call option with a strike price of rupees 20 and a 1 year put option with a strike price of rupees 20? The call premium is 1, put premium is 2. The current share price is 19. If 1 year later the share price decreases to 15, how much profit you earn? So what do we do? First we calculate how much we have paid here. So we have paid for 1 C0 and 1 put ratio put option 1 C0. And we have paid is 1 and 2, so we have paid total is 3. The strike price is 20 and share price decreases to 15. So from call, I will get 0 and from put, I will get is 5. So my net will be 5 minus 3 is equal to 2. And that this is positive, therefore this is the profit of rupees 2. Okay. Okay, next we come, suppose the risk-free rate is 4%, expected market rate return is 9%, value of beta security is 0.6 according to CAPM. What is the expected rate of return? This is straight away from the formula, it will become 0.40 will calculate in the interest also 4 plus 0.6 into 9 minus 4 plus 6 5 7%. Next, security A has an expected return of 18%, standard deviation is 20%. E has an expected rate of return 16%, standard deviation 45%. If the rate of return of these two securities have a correlation coefficient of 0.4, what is their covariance? So covariance formula is equal to correlation coefficient into sigma 1 into sigma 2. So this will become 0.4 into sigma 1 is 0.2, sigma 2 is 0.25. So we calculate this one here. 100, 1, 2, 3, 4, 0.02. Or we convert it to the percentage, then it becomes percentage.
Sir, can you go to the previous question, please?
Yes. This one?
Yes. What's the formula here?
ERI is equal to RF plus beta into E of RF minus RF. So
Okay,
RF is 4, beta is 0.6, RF is 9. It's okay.
Yes, sir.
Okay. So with this, we have done this P by Q. Shall we solve the another one also? I think it has got some additional questions or same questions.
Yeah, we can. Sure.
Sir, there is one more formula for expected return for a stock X, which is EQ minus price upon price. What is that?
What is that here?
ERI is equal to EQ minus P upon P.
EQ minus P over P. No, this is from the formula for ERI. From here, what do they do? See, what do they do? This is very important. They calculate actually the stock price. The stock price can be calculated by 3 formulas. So one, we use the hedge ratio to find the call. I am using hedge ratio, calculate the call price. Second was from the risk, minimum risk. So from here, what we have from the PRI is equal to RF plus beta into expected RN minus RN. Yes. But we also know that your expected return is equal to Q minus P over P. So when you equate these two formulas, so this will come RF plus beta into PRF minus RF. So when you open this will become Q minus P is equal to P RF plus beta P RF minus RF. So therefore, your P, if you bring it here, so this will become 1 plus RF plus beta P RF minus RF is equal to Q. And here then this is the formula for price of the stock. This will become Q divided by 1 plus RF plus beta into P RM minus RF. This was the formula. This okay?
Sir, what is Q over here?
Q is your expected return. When you say that I expect that this stock will become rupees 80.
Okay.
So what is ER then? Oh, expected return. ER is expected return rate, right?
Of the market.
Okay.
That market is supposed to grow by 9%, for example. Your risk-free rate is, for example, 8%. And I'm saying that this stock will, after 1 year, it will be rupees 80. So what is the present price of this stock? This is given by this formula. Okay, shall we open the?
Sir, I have a doubt. So
Yes.
in this question, if like how do we identify that if they are giving the ERI or the Q?
No, see,
Because both are the expected rate of return, right?
no, this P is not expected rate. P is the price of the stock.
Expected price.
Price of the stock.
Okay. And sir, the Q will be?
Q is an opinionated or expected the price of the stock in future. So
Okay, okay.
I say it will become 500 after 1 crore. And these are the values I know. So what is the present price of this price?
Okay, so Q will be the expected price and ERI will be the expected rate of return, right?
Yes.
Okay, sir. Thank you.
Okay. And here only again can cover that formula before we forget. Your P which is there, the P, this is the probability of increase. This is 1 plus RF minus P over Q minus P. If it is not continuously compounded, and if it is continuously compounded, then it is E to power RT minus D over U minus A. So this P and this P are different. This is price and this is probability. Okay. Okay. Now with this, shall we open the another one? The second one is the probability. So this is the second one. There you see the questions. There was a different question. Okay, it is the same question. This is also the same question. I think this is the same question. The same question. Let's check. Okay, so there are no differences. I think the question paper is same. Anybody wants to ask any question from GS, PAs, or from any B, or discuss any concept here?
Yeah, sorry, I joined pretty late. I thought the meeting was at 8.
Okay.
Could you just please explain the call and put options where the minus C is minus or not? Like it's short if
Yeah,
it's not a problem.
no problem. We have covered the concepts of call and put and what we will do selling and so we have got something called call and we have something called put. Both can be sold and both can be purchased. So what is the meaning of call? that if we have got a share of rupees 50, I purchase a call, for example, I purchase a call and they have got a strike price. So this is the strike price, for example, I say 60, and then I will make money only when, for example, I have paid, for example, 10 rupees for purchasing this call. I will make money only when this will go above 70. So in this case, call, my profit which is there, it is unlimited. So this price can go anywhere. And the loss which is there, I will have maximum loss of rupees 10 only. Is this okay? Solve it?
Yeah, got it. Yes.
Okay. In the put, it is just opposite. The price is 50. I purchase a put of rupees 10. Strike rate is, for example, 60. I will make money only when the stock price will go below 60. If it goes above 60, I am having a loss of -10. And if it goes below 50, then only I will make a profit.
Okay, so it has to go down below 60 over here.
Below 50, then only I'll make a profit because I have to compensate for rupees 10 also.
Sure.
Okay. And this is when I'm purchasing. So this is purchase. Now, when I sell and call option, when I sell, so what happens? The stock price is 50. I have sold one call option. So somebody has purchased that rupees 10. Okay, so somebody here it was minus, sorry, so here it is. Minus going out of my pocket. This is minus 10 and minus 10. When I sell, so I get rupees 10. The strike price is rupees 60. If it is less than 60, I am making profit of 10. And if it goes above 70, then only I will make loss. Otherwise, from 60 to 70, I am again at profit. Is this okay?
Okay. So in this 670 goes, it's basically 60 minus 70 over here, right?
Yes. So I have to pay amount X minus 60.
Got it.
Okay. And now when I sell a put option, so I get 50, I get 10 rupees. I will pay only when the stock price go below 60, and to make profit, the stock price should not go below 50. From 60 to 50, again, I will be at profit. Okay, so this is purchasing and selling.
Okay.
Okay. Now I will cover one more concept which we have not covered in today's session. That how this C0 is calculated, call price. So what do we do? How we make the scenario? We say that there is a stock which is going at 100 rupees. This is C0, and we say that its strike price is 110. And we assume in the future that there can be only two scenarios, that either it can go to, for example, 120 or it can go to rupees 90. So these are the two scenarios. And building this scenario, we decide, we calculate the C0. So how do we do, or what are the steps? So first step is calculate the edge ratio. Calculate the edge ratio. So edge ratio is nothing, your CU minus CD divided by SU minus SD. The CU is the profit when it is going up. So your C is 10 rupees. CD is always equal to 0. So your edge ratio will become 10 over 120 minus 90 is 30 is equal to 1 by 3. And what is the meaning of this edge ratio? That for every call option, I have to hedge 1 by 3 share. 1 by 3 share. And the meaning is that I have to purchase 1 by 3 share. So it means I will have a share value of 100 by 3. So I have got present value 33.33. So my present portfolio is 33.33 and I'm purchasing one call option. So this is my present value. Is this okay? This is your step 2. Now your step 3, calculate your portfolio for D down. Now when it goes down, your portfolio will be 90 divided by 3 because you got only 1/3 share. So your value is 30. And now you take the present value of this 30. Present value of 30 will be equal to 30 divided by 1 plus RF. So for example, if RF is equal to 10%, so this will become 30 divided by 1.5. And these two values which are there, these are risk-free. I'm building a risk-free portfolio. So 33.33 minus C0 is equal to 30 by 1.1. And therefore, your C0 is 33.33 minus 30 by 1.1. So this is how you calculate your call premium.
Okay.
Okay. And just as a precursor, for example, you have calculated your C0 that it is coming, for example, ₹6. And in the market, your call price is either above 6 or below 6. Then these are the arbitrage opportunities. It means by playing put and option, there are opportunities to make money. Okay.
Okay.
So this was all about put and call.
Thanks.
Any other question from anybody? Okay, if there is no question, then we can call it off. All the very best. Thanks for joining in.
Thank you, sir.
Thank you.
Bye-bye. Bye-bye.
Thank you.
Bye-bye.
Thank you, sir.
Bye-bye.